Welcome to the Lend Academy podcast, episode number 153. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's show is sponsored by Lend It Fintech Europe 2018. Europe's leading event for innovation in financial services is coming up on the 19th and 20th of November in London at the Business Design Centre. We have recently opened registration as well as speaker applications. You can find out more by going to lendit.com/Europe. Today on the show, I'm delighted to welcome Tom Burnside. He is the CEO and co-founder of LendingPoint. Now, Tom has been around this industry for a long time. He's got some fascinating insights onto the industry as a whole. And he came out of retirement just a few short years ago to start LendingPoint. And so we talk a lot about that story. We talk about their approach to underwriting, the sort of the segment of the industry that they're focused on. We talk about a new acquisition that they did just a few months ago, and their loan performance and how they're sourcing capital today. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Tom.
Thank you, Peter.
So I'd like to get these things started by getting a little bit of background about yourself. I know you've had quite an interesting career. So why don't you give the listeners some of the highlights of your background?
Sure, Peter. So I have been in the credit market, telling credit stories or big data stories for 20 plus years, or closer to 25. Mm-hmm. And my story really kind of starts back when I was working with a company called First Data. And at that particular point in time, we were trying, our mission statement at that point was to try to make a transaction as quick as possible. We were kind of moving out of more of a manual process for authorization of credit cards and for, at that point, checks. And what we were trying to solve for was to make sure that we could make the merchant's experience as easy as possible for them to accept a credit card or a check. And so we really started using data at that particular point of time to differentiate the good guys from the bad guys, the transactions at the point of sale. And so we started by first building big negative databases that allowed us to identify customers that were going to be bad or had been bad before, and the probability was very high that they were going to be bad again. And where we found ourselves was trying to become creative in saying, okay, now we think we can predict the people that are going to be bad in the future. And unfortunately, not always that didn't always work as well as we would like it to work. And I'll give you a really quick story there. One day I'm sitting in the offices at a company called Telecheck at that time, is who I was working with for First Data. And the mayor of Houston had just been declined for checks that he was writing during the holidays. And he was not a happy guy. And, the realization around the table quickly at that particular point was, hey, guys, the bad check writer and the good check writer look very similar. They both write a lot of checks. And so, how do we distinguish between the good check writer and the bad check writer? It's going to take more than just a negative database, and it's going to take more than just a frequency count to make sure that we're deciphering between the two. So the first thing we did was something that hadn't been built yet, and that is we actually built for credit card and for checks. We started building a good check writer base, or a good transaction customer, a good credit card customer base. And what that meant is that we start storing information immediately upon every transaction that would come in. We start incrementing your files and putting you in different ranks of just how great of a customer you were and how many times we had seen you, the frequency of your transactions, cyclicality, meaning that during seasons you might do more than you do during the middle of summer. So we start to really kind of compile this information. So that was my first endeavor into building databases and systems. Using kind of the power of data and technology to tell the story of somebody in a unique way, right? Over the years we've done that. Over the years, we've been developing that particular technique. I did it recently. Probably, I guess now I say recently. Now probably 18 years ago. We did it with 19 years ago. We did it with a company called Comdata Gaming, which became Global Cash, which was a publicly traded company for a while. It was taken private just a few years ago. But there we were solving for a different issue, and that was the consumer. You had a recreational gambler, and you had a more of somebody that was more of a tourist, right, that was coming into Las Vegas or into one of these gaming institutions with less frequency. And what we needed to do there was to be able to issue lines of credit or approve their check or credit card transaction within seconds, so they could go out and enjoy the entertainment. Mm-hmm. And so that transaction took typically about 35 minutes to 40 minutes to move through. We got that down to about 12 seconds. Wow. And that became a booming industry, but it was really around our ability to be able to tell the story with, again, unique credit, being able to separate the difference between a recreational gambler and somebody that was was a tourist, right? And so we might have not seen them anywhere else, so we had to use other data sets to be able to complement that story. Mm-hmm. That really took me to Can Capital, right? I was recruited away from First Data to move into Can Capital to be able to take kind of data, unused data, and a very thin credit file, which was a small business owner, and be able to give them access to capital by using data that wasn't traditionally used in credit scores to be able to tell their story and give them access to credit.
Right. And so I know that you spent quite a bit of time at Can Capital, along with others on your team there at LendingPoint. So what was the sort of the original impetus to leave and really to start LendingPoint? What was the original vision there?
What's interesting about the small business market, I had been doing it for almost 14 years. And what I had looked at as I actually retired, I decided to step aside for a while. At that point, Can was contemplating going public, and so I had an opportunity. I said, look, I kind of taken it where I can take it. And so I decided to retire. Mm-hmm. What was interesting about it is a couple of my partners we had done some business with prior, and we'd actually tropicalized the small business lending. And so Juan Tavares and Victor Pacheco, my partner at Can, which was Frank Fatras, came down to my wine cellar and said, "Hey Tom, we got to talk about we got a new idea. Do you want let's talk about consumer." And so that was really kind of the impetus of this. And then we were just kind of talking about what was the opportunities and how would you go after it. And my wife said, "Boy, this is a great time for you to get out of retirement. I need to get some things done." So here I am.
Right. So just on that, I'm actually curious to get your perspective on the shift from a small business focus, which obviously Can Capital. These are small businesses, often with the owner of the company very much a part of the credit and underwriting decision. How does that sort of translate to a consumer lending operation?
The disciplines are very similar, right? What you're doing is, so what we chose to go after in this market when we really said, look, let's start up LendingPoint, was we wanted to go back into credit and tell the story of an underserved customer, right? That underserved customer, and the target that we were looking at was a customer between 580 and 680. And the uniqueness of them, as well as a small business owner, is both of them have very thin files. Mm-hmm. And so what a lot of why you see the teammates around me right at the moment that I have brought with me is because those teammates came with me because they knew how to tell stories on thin credit files and use alternative data to do so, right? And differentiate between a good credit and a bad credit. And so, I think the disciplines are very similar because it was both an underserved market that needed to be complemented with other types of information to help round out their story. Mm-hmm.
Mm-hmm. Sure. Then, so can you mentioned that a credit score between 580 and 680, but beyond that, can you sort of give us a little bit more of a picture of the typical LendingPoint customer?
Yeah. So our core business, as we started off, the core business was really targeted at 580 to 680. The average customer was around 655 to 660. Mm-hmm. It was somebody who'd been on their job for roughly 10 years. They tended to have thinner credit files. What we've been told by some of our larger online aggregators is that, by us using this additional information and augmenting the data to tell a better story of the customer, 30% to 40% of the time, we're actually giving a unique offer or an offer that they weren't getting from anybody else. And so, that customer, they've been on the job for 10 years. They tend to be, a 665 customer. They tend to be looking for about $11,000 or so. And for a variety of reasons, it could be anything from adopting, a child to a wedding to consolidation of bills. So it can be kind of across the board. Mm-hmm. That's been our core customer for a long time. That's obviously diversified recently.
Mm-hmm. Mm-hmm. Okay, so then what are the typical, can you just give us a sense of the loan terms that you're offering in your core product here as far as, interest rates, length of term? You said it's $11,000 average, but what are the other terms on the loan?
Yeah, so the customer is typically seeing something in that 11.99 from an APR perspective, 11.99 to about 34.99. Mm-hmm. They're seeing offers from 24 months to 48 months, right? And typically the average is right now about 41 months if you kind of look at the overall blend of the portfolio. Mm-hmm. So this is this in the core product today. That profile has been pretty consistent over the last few years.
Right, and you mentioned that this is a segment that is it's less competitive than the prime segment. That's for sure. And you said oftentimes these people don't see many other offers or any other offers. But so how are you actually acquiring these customers? What are the different approaches you use?
Well, we use a variety of ways. One of the ways that we do it is obviously the large aggregators. You can see us, between a LendingTree, a Credit Karma, a .818, Underground Elephant, and kind of across the board. We have about 300 partners that are pointing to us today. Mm-hmm. Some way or the other, but some of them are simple referrals, right? These are people that are, we're either a link on their website, they're just pointing to us for a transaction, and we may be the only person, looking at that transaction. So it's a variety of different ways that we see it. We also do emails. We have SEO. We do our own mailers, right? We'll drop 1 million pieces roughly this month. So we're across the board. We're acquiring customers in multiple different ways. What was interesting in it, one of the areas that was emerging was really kind of, for us, was this point of sale, right? Mm-hmm. And we start to see a lot more of those transactions coming our direction, and so we have been focused on that as well.
Right. We'll get to that in a little bit, but before we get there, I want to actually dig into your underwriting approach, because you've talked several times already about the use of data and the use of alternative data for thin credit files. Can you tell us a little bit more about that and what kinds of data you're using and how your approach to underwriting, what you do that's different when it comes to underwriting?
Yeah, so the question that we're always trying to answer, it's not about the quantity of the data, but it's the quality of the data, right?
Mm-hmm. Sure.
And just how predictive it is in making a decision with a customer. And what we're really trying to always understand is the customer's willingness and desire to pay. Mm-hmm. Because if you can understand that, not everybody, you didn't grow up as a 800 FICO. You had to grow into that score, and the way you grow into that score is by having good transaction history, good credit transaction history, right? But you have to have enough of it that builds a big enough profile to build that score. Mm-hmm. And so a lot of people don't realize is that, a thin credit file, that doesn't mean they're bad. It just means they have a thin credit file. Mm-hmm. And a thin credit file will typically keep you below a 650 FICO. And so millennials are learning that the hard way, right? They millennials specifically is somebody that hasn't established a lot of credit. And if you really get below 3 credits, you need to 3 credit reporting agencies, right, or 3 credit reporting vendors. What you need to augment their story with other information, like cell phone information, like light bill information, things of that sort that allow you to get a better understanding of their willingness and desire to pay back.
Mm-hmm. Right, and then sort of how is sort of technology weaved into this whole piece? I know when I was in your office earlier this year, and you had quite an impressive operation there. Saw lots of there's lots of technology everywhere. So tell me a bit about what you're doing there.
Well, when we start to look at this, I think that the first thing you're trying to solve for is you're trying to solve for the ability to scale the business. Make sure that it's a reliable platform. Make sure that security is foremost. That you're taking care of the information that the customer has enabled you to view or to access, right? Mm-hmm. And so those are kind of your core fundamentals. From that, the next issue is really saying, okay, how do you use data to tell stories that affect the overall organization, right? And so what that means is that not only are you trying to tell credit stories, you're trying to store data in a way that is indexable, right? That we can use it to create additional variables, additional information in the future to tell a better and better story. So to kind of give you an example, when we started the organization, we started with 8 variables. Today we're at 56 variables to make a decision on a customer. Mm-hmm. Right? That came through a series of being able to take that information and log it in such a way that we were able to go back and do a better job of understanding it. So we grabbed a lot of data up front, and then we put in a system called Hortonworks on our side. And Hortonworks allowed us to use structured and unstructured data to be able to tell stories across the organization. So, structured data is used for credit decisions, but unstructured data can be used for marketing decisions. It can also be used for skill-based routing. When a call comes into the building, who best handles that call? Well, what call should I be prioritizing up front? So when you think about it, when we looked at the scale, the reliability, and security, we said, look, we're going to use AWS, right, or the Amazon Web Services to give us this massive amount of scale, right, that allows us to kind of plug and play and build. We can take on 30, 40, 50% bump in transactions. I'll give you an example. Last month, we took on 370,000 transactions. The month before, we'd only saw about 260. Mm-hmm. So when those things happen, you need to be able to have that kind of reliability in your systems. But then we use the Salesforce Rail, right, which keeps the information, very, very structured for us. I mean, it really works as a magnificent CRM for us. And then from that, we plug in all the kind of the components that allow us to give that customer that frictionless process, right? On top of that, now you're looking at things like GDS, right, which is a rules engine that allows us to strip off transactions at the top of the funnel when a customer comes in and sell that particular transaction in the way that a bank would want to see that transaction. We can strip it off and give it to them first, and then rank order the rest of the transactions through our normal systems. Mm-hmm. So, we are very, very dependent on obviously systems in our case, and it's used everywhere from marketing to the actual credit to the operational side of the business.
Right. I remember you showing me some of the cool dashboards you had on your phone that sort of monitored everything. That whole thing was quite impressive to me. So anyway, I want to talk about the acquisition that you did a few months ago now of Loan Hero point of sale platform. You mentioned point of sale earlier. So firstly, maybe we can. This was your first acquisition, I believe. So tell us what was behind that decision to acquire a point of sale platform.
So I think when we start with this, what you will see is a lot of times what we're doing inside the organization is we're identifying new areas of opportunity. And what had emerged in our overall reviews was we were starting to see a lot more point of sale transactions. So the partners that were plugging into us were plugging in to solve a point of sale need. And so, we start building that. We start plugging in more and more of these partners, and we're doing $5 or $6 million of it a month. And so the conversation at the executive team was, hey, do we buy this or do we go out and build it? And what we found was an opportunity to buy something that allowed us to get to market much quicker. Mm-hmm. And as a result of that, we purchased the company called Loan Hero at the end of December of last year.
Right. And then so how you sort of integrated them into your organization? You're based in Atlanta. I believe they're in San Diego. How have you integrated them into your organization?
Well, so, that's a great question. I think from our side, we were looking at them as a technical platform only, right? That's really what we were looking for, was to try to build. And what I mean by tech platform is you kind of have to think about the merchant's experience is different than the consumer experience. Mm-hmm. And so their front end really works with the interface as an interface with the merchant, and our back end works as the interface with the consumer. And so the merchant can select, that platform allowed us to have the merchant select the offer they wanted to give to the customer, right? And what that delivery would look like. So they can choose a discount rate, they can choose the type of product they want to deliver to the consumer. And then that identifies the criteria, and it comes to our back end here. And our back end here then makes the credit decision with the understanding of what the product is that they wanted to offer to the customer. Mm-hmm. And so what it really allowed us to do is have more of a merchant-facing platform. And we're still using the rails here in the back end to do all the credit decisioning, and the data capture.
Right.
On the Loan Hero acquisition, all we did was buy the platform of the organization. We didn't buy their customer base and other things. We specifically bought the platform, right? That was the transaction there.
Right. Okay. Makes sense. So I want to talk about a recent announcement that you did just earlier this month. You made an announcement about a $600 million credit facility from Guggenheim. And I know this was, I think you also had an existing facility with them. Tell us a little bit about how you're able to get that deal closed and what it means for LendingPoint.
So, the Guggenheim team has been a great team to partner for us, right? But I think that, what it has allowed us to do is to really build the capacity to continue to serve our customer, and both of our customer and our customer's customers now, right? Mm-hmm. As a result of that, we now have about $1 billion of access to credit to be able to balance sheet, that $1 billion. They're also walking us through today. They're moving us in through the Kroll rating, so we'll have a rating on the assets before the end of the year, mm-hmm. which will allow us to get more access to the ABS markets and otherwise. And that, to us, is kind of the ongoing journey. So they're actually being our partner in that process to take us through that journey.
Right.
Yeah, so I think this has been, the other thing is you probably recognize the rates are amazing with it. I mean, we're coming in at 4.67 spreads. We got a 90% advance rate. Mm-hmm. Most of that is just because we've had phenomenal credit performance. We were oversubscribed. JP Morgan was the lead in this, as well as Macquarie, mm-hmm. were the two leads. And it's worked really well for us, and we were oversubscribed in the other, an A, B, and a C tranche. We were oversubscribed in the other areas as well. Right.
Okay. So then, what can you tell us about credit performance? Obviously, you've been in business now for a few years. You've had a few turns on your loan book, or at least a couple of turns. Can you give us some sense of where performance is coming in versus expectations?
Sure. Yeah. So some of the early vintages, the pull factors are pretty well done. Mm-hmm. As an organization, the discipline at the organization has been really to augment the scoring model. So it's allowed us to stay consistent on our journey. And performance right at the moment is, we're going to come out somewhere between 13 and 15% write-offs on most of the pools, roughly 17, the end of 16, 17, and obviously this year. I don't know that that's the right number yet. I think we might want to bring that up a little bit so that we can serve more customers. Mm-hmm. Because, when we think about our targets, we're really pricing it to be around a 15. When we're coming in at, the 13 handle, it doesn't feel right. It doesn't feel like we're maybe saying yes frequently enough. But we continue to refine that. You don't do that in big movements. You do that in slow movements.
Sure.
But I think that we're feeling very good at where we're at. We're really trying to get, what we think about the world is we think about this as a 2x coverage. So we want to be able to absorb some beta risk in the portfolio if something were to go bump in the night, a shift in the economy or otherwise.
Right. That makes sense. So then what about scale? I mean, can you tell us like how many states you're operating in, what kind of scale when it comes to to loan originations you're at today?
So today we operate in 49 states plus DC. Mm-hmm. And so you could access a loan, on one of our platforms in 49 states plus DC today.
Okay. And so what about, can you give us some sense of volumes?
Yeah, so we've been running, we're just now bringing up really the point of sale. So it hasn't contributed at the levels yet that we are anticipating. But overall, we'll close this month probably around 45 million. Last month we did 44. We'll do 45, 46 million this month. We should be closing in on $70 to $75 million a month by the end of the year, right. Based on our current projections. And some of this, Peter, to be honest with you, is us digesting the volumes we're currently seeing. I mean, so just by example, we do $43 million on about 260,000 applications that we saw coming through. So some of this is on us, just to make sure that we're digesting it at the appropriate rate, make sure that I'm staffing right? So that bump we saw again recently in volume, we just need to be able to digest that. If we digest it at the same rate as we have before, this is a $75 million a month business without us really needing to expand our acquisition channels.
Right. Okay. And what about profitability and generating cash flow? Where are you at on that journey?
Well, thank you for asking. I think this is a wonderful part of our journey, right? In 3 years, we're going to be generating over, this year, we'll generate over $100 million of revenue. Mm-hmm. And that is a very unique, if you think about the market and others that are in this space, that's very unique. Mm-hmm. I think the second thing to it is that we'll get into cash flow position of being positive this year. We'll get into an EBITDA positive first quarter of next year. Mm-hmm. We pushed that off a little bit with the acquisition because we knew that we were going to have to spend a little bit of money to get the platform up. We were originally targeting to be profitable by third quarter of this year on an EBITDA basis. But then we pushed that back off a little bit for the acquisition, which I think at this point was the right thing to do.
Right. Yep, that makes sense. So we're almost out of time, but I want to step back a second and ask you to sort of look around, like when you look around the online lending space. We've talked privately, and you've mentioned some of the things you don't like about the space, and I'm curious to get your sense on what do you see, what are we as an industry doing well, and what are we doing poorly at?
I think there's two areas that I continue to be impressed by. One of them is I think the industry has done an amazing job of allowing a consumer to know that they can make a transaction, in the comfort of their home, on a beach with their cell phone, but they can get access to the financial needs that they have. And the industry, I think, has done an amazing job with that. Mm-hmm. And you can see that in the most recent TransUnion study, where it's showing the access to that the consumer unsecured lending is growing at a pace faster than even credit cards, right? So I think that's an amazing feat. Mm-hmm. I think on the other side of it is that, the process continues to be more or less friction in the process, right? It's more friendly to the consumer. Mm-hmm. And so I think those are two areas we've done an amazing job with. The areas of concern that I have, and I've voiced these with you, in the past, but I think the two areas of concern is predictive outcomes on the credit. We as an industry, need to continue to focus on the predictive outcomes of credit, because that's where not just the consumer confidence, but our investor confidence comes in play, right? And their willingness to continue to sponsor this industry, this fledgling industry that's really starting to blossom. Mm-hmm. I think we need to make sure that there's a lot of confidence there. And you saw that being evident in the fact that premiums have started to dry up, starting in 2016, right, because they weren't getting the kind of outcomes they were looking for. And you see that even on some of the crawl ratings, that you look at, you can see what they said they were going to come in and what they actually came in at, right? So what we really need to do is continue to focus on telling a story and getting quality credits. I think the second part to it for me is, as we become bigger and larger as an industry, more and more focus, and every day there's another article about how the CFPB or local attorney general is looking at this space. We need to be in the forefront of education, I think, and just make sure that we're guiding the process, and that the lawmakers are understanding the real story and how we're making credit accessible and how we're growing the economy and what the benefits are for our services being available, and then help guide the process. Because at the end of the day, this is not the Wild West. We want it to grow, flourish, and blossom in such a way that allows this to be a sustainable industry for years to come. Mm-hmm. But I think that it's going to be that education process, to our lawmakers that are going to allow that to happen.
Right. No, I completely agree. We need to do more and better in that area. So anyway, last question before I let you go. So what are you working on specifically at LendingPoint? What's the future looking like over the next 12 to 18 months?
I think the next 12 to 18 months is very exciting, right? As I look out to this, to the next year and a half, what I'm seeing is an opportunity to make money as accessible on a term loan as it is by using your credit card, mm-hmm. right? This should be money on demand. This should be as easy as me using my cell phone, going to a transaction at the point of sale, and being able to pay for that transaction in the same way I might my credit card. The fact that we can turn an authorization back to a customer in 5.5 seconds makes it as usable as a credit card. We need to make it more and more accessible at the point of sale so that if somebody's buying a large ticket, they have the same ability to use their phone as they would a credit card to get a term loan instantaneous.
Mm-hmm. Yeah, that makes sense. Okay, well, we've run out of time, but I really appreciate you coming on the show today, Tom.
Well, thank you, Peter. I appreciate you taking the time to learn more about LendingPoint.
Okay, we'll see you later.
All right, bye-bye.
Bye. I just want to pick up on that last thread that Tom was talking about there when it comes to point of sale. I'm very bullish on this space. I think it's got tremendous potential, particularly over the long term. I think right now we still are very much a credit card focused and cash based to some extent ecosystem when it comes to point of sale. I see that changing certainly over the next 10 years, where it's going to become a mobile-centric experience. Just got to look at China, where that's the vast majority of retail sales now are done over a mobile phone. And that will come to, I think it's inevitable, it comes to developed economies as well, including the US. When that happens, I think you're going to see an approach here where you'll certainly have credit cards. They'll be around for a long, long time, and you'll be able to put something on a credit card, whether it's through Apple Pay or Android Pay or some other pay system that will be around for decades. But I think you'll also see a seamless integration of lending platforms into this experience, where you'll be able to go up to the counter and buy a couch and put it on a loan from a point of sale provider just as easily as you can put it on a credit card. And so we're not there yet, but that is coming. And that when that actually arrives, I think you will see an explosion in the amount of volume that goes through these online lenders at the point of sale. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lendit Fintech Europe 2018, Europe's leading event for innovation in financial services. It's happening November 19th and 20th at the Business Design Centre in London. Registration is now open, as well as speaker applications. Find out more by going to lendit.com/Europe.